Okay, let's talk about something I know can be a real headache for small business owners: how to handle expenses you've paid for a customer. It seems pretty straightforward, but if you get it wrong, it can really mess up your financial reports. So we're going to clear all that up right now.
I mean, you've totally been there, right? You pick up some materials for a client's job, maybe you cover a shipping fee on your own card, and you're fully expecting to get paid back. But then you sit down to do your books and you just kind of freeze. Where does this actually go?
So let's be super clear on what's happening here. Money left your bank account, yes, but it wasn't for your business. It was for your customers. And this is the most important thing to remember. It is not your expense. Think of it more like a short-term loan you just made. And honestly, that little mental shift is everything. Before you even think about recording it, you've got to classify it the right way in your head. The moment you start thinking of it as a small loan you gave your customer, all the bookkeeping stuff just clicks into place. Now, the official fancy accounting term for this loan is a current asset, or you'll hear it called a receivable. But don't let the jargon throw you. All an asset is something your business owns that has value. And in this case, that IOU from your customer, that's an asset. It's money owed to you. I really like this slide because it just lays it all out so perfectly. Over on the left, you see a business expense. That hits your profit directly. It brings it down. But look at the right. This customer receivable, this asset, it has absolutely zero effect on your profit. Why? Because it's not your cost to begin with. It's just your money hanging out somewhere else for a little while, waiting to come back home. All right, enough theory. Let's get practical. We're going to walk through the very first step, what to do in your books the moment you actually pay for that customer expense. So in the real world, two things just happened at the exact same time. First, pretty obviously, cash left your bank account, so that balance dropped. But second, something new was created, that IOU from your customer. Your books have to show both of these things happening together.
And here's what that looks like in proper accounting terms. And it's actually pretty simple. We debit the customer receivable account, which just means the amount of money owed to you went up. And at the same time, we credit your bank account, which means your cash went down. See that? It's a perfect balance. One thing goes up, another goes down. Great, so you've recorded the money going out the right way. Now we get to the fun part, getting paid back. Let's look at how you record that money when it comes back into your business. And just like before, two things are happening at once. First, your bank account balance goes up because you just got that cash. And second, that IOU from the customer is now gone. It's settled. They don't owe you that money anymore. And this is the entry that closes the whole loop. You can see it's the exact opposite, a perfect mirror image of the first one. We debit the bank account because your cash went up, and we credit that customer receivable account, which brings its balance all the way back down to zero. The debt is cleared, and you're done. So let's just quickly talk about the trap you need to avoid, because this is where a lot of people go wrong. If you had just recorded that initial payment as an expense, say to office supplies, you would have accidentally made your business look less profitable than it really was. That one little mistake gives you a totally false picture of your financial health. All right, let's wrap this all up with a super simple set of rules you can follow every single time this comes up. Just think of this as your little cheat sheet for reimbursements. So it really all comes down to this simple little circle. Money goes out, you create a receivable. Money comes back in, you clear that same receivable. And because you do it this way, the whole thing never even touches your profit and loss statement. The receivable balance just goes up, and then it goes back down to zero. That's it. And why does this one little detail matter so much? Well, because good bookkeeping isn't just about being ready for tax time. It's about having numbers you can actually trust. It's about knowing your real profit so you can make smarter decisions about your business. When you get these small details right, the big picture becomes so much clearer.